The biggest dislocation I've ever seen in markets continues, and it actually continues to get worse. Not only is the spread between what the Fed projects and what the market projects in terms of rate cuts now expanding to 150 basis points by year end, but we're getting solid Fed speak confirming their commitment to the rate hiking cycle and confirming that their bias is actually not towards cutting, but towards over-tightening farther than they've already said. That's apparently the most likely scenario, is for them to keep ratcheting up the tightening according to Bullard. Now, let's talk about why the market is not reacting to that. The market is actually reacting to headlines around a banking crisis, panic fears, a massive fall in yields that has led tech stocks very strong. Look at mega cap tech. I mean, the QQQ, I believe, is up something like 20% year to date. That is tremendous. I believe that's what it is. You can feel free to correct me if I'm wrong, but look at Apple, look at Microsoft, look at Amazon, and look at Google. These are the four biggest companies in the world. They all also happen to be either declining or flat earnings. Apple, Amazon, and Microsoft all declining earnings. That's an important thing to me. I think the fundamentals matter. I have been having probably the worst period I've ever had as an investor in my life right now because the fundamentals have not been prevailing. It's quite frustrating. But I don't make the rules. I got to deal with it. But I think that ultimately, as I've seen many times throughout my life, the fundamentals do and will prevail. It's just a matter of time. But unfortunately, it also is leading to some capital reductions, capital burn. There's no good outcome with that. Anyways, Bullard is telling us that the Fed is committed to 2%. The market wants to price 150 basis points of cuts starting in June. That's just not going to happen. I don't know what to say because like I said, it's simply the biggest mismatch I've ever seen. And I'm trying to have a cool head here. I'm trying to stay calm, detach, and analyze the picture. And I can't make sense of the fact that the 2 years spent most of the day below 3.7%. But rates are projected to be above 5% for most of this year, above 5% for most of next year, and only towards the end of next year begin to slightly taper below 5% and above 4%. So for the 2 year to be lower than 4%, lower than 4.5%, in my opinion, doesn't make any sense. I simply don't have an explanation for it. The market is fighting the Fed. The fundamentals are all in our favor. It really is. I've been playing this with options, and that's what's been causing the capital reductions. I would obviously feel a lot better if I didn't have losses, but I have losses. So it's a very interesting scenario, but I'm confident in the fundamentals. I get it. People say there's a lot of cash on the sidelines. Sentiment is very low. That is not what determines the valuation of a company. That was an argument and the case all of last year. Cash levels were high. They were higher than pre-COVID levels. Sentiment was low, and the market fell 20%. Sometimes that doesn't matter, cash levels and sentiment. What matters is interest rates and fundamentals. And right now, I see fundamentals deteriorating significantly. I see inflation staying hot. I mean, you can look at core PCE. It's hot. It's not going anywhere. It hasn't really gone anywhere at all. Yeah, it's slightly moved down, kind of, on a higher bases. But look at the month-on-month change. It's right up there with the all-time highs of this inflation bout. And if core PCE rather, comes in the same way that core CPI came in, it's going to be another month of reacceleration. Core CPI was 4 months. Core PCE without February's data is 3 months. We're going to get that next week. I think that's going to be the day of reckoning, but we're going to see what happens. We've got more Fed speak next week. We've got Waller following up the PCE. So hope you have a good weekend. That's today's video. And until next time, peace out.